They're out of cash. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, McDonald's just issued a massive warning, and I want you to understand this has dire implications for the broad U.S. economy, and you're not going to believe what the executives are doing in response. But McDonald's is not the only company facing issues, as you're about to see. I'm going to show you some shocking new evidence that shows the U.S. labor market and the entire U.S. economy are about to unwind. And with that, let's head over to the street where we picked today's story up with a headline as McDonald's new $5 meal deal isn't going as planned, well, at least so far, and the evidence is mounting that it's not going to go well because not just an issue of consumer habits changing, it's the fact that consumers are running out of money and the labor market is starting to unwind and about to accelerate in a big way. And after McDonald's flagged concerning trend in the restaurant industry with consumers pulling back on their spending on fast food due to pressures from inflation, it unveiled a new $5 meal deal on June 25th to help lure back frugal customers. The promotion, which will only be available for a limited time and, well, probably extended as you're about to see, allows consumers to purchase a $5 meal that consists of a chicken McDouble, 4-piece nuggets, fries, and a drink. And here's my question for you. Was this enough or any of the other fast food deals enough to get you back into their stores? Weigh in the comments below. What do you think's going on? As now more than a month after the menu made its debut, McDonald's is reportedly failing to see it boost foot traffic at its restaurants, according to BTIG analyst Peter Sala, who analyzed a series of franchise checks conducted by his firm. We note that comparisons eased in July, with the current month impacted by the timing of the July 4th holiday and Hurricane Beryl in Texas, but he noted it was too early to know if the $5 meal menu will derive profitable incremental traffic, and the evidence is suggesting that it is not, and that it is likely going to be extended in September and even further, as we're about to make the case, because one thing that is experienced positive sales growth, even though it's not McDonald's, it should be your trading account, because our subscribers are making money. Check this out. As of close of business yesterday, our CTA Timer Pro, which looks at machine positioning, we were holding on to 10 open trades, 8 are up. That's an impressive 80% win rate, and we've got some big returns sitting on the books. Momentum Timer Pro has a whopping 15 open trades as of this morning, and every single one of them are up. 3 were stopped out yesterday, 2 for massive gains. How do we do this? Well, our CTA Timer Pro looks at machine positioning, and when we find the machines are deep short, like signals like this, and price moves against it, our report alerts us, and we tell our subscribers, if you like trading momentum like the RSI and MACD, we look for big pullbacks over the monthly momentum and then a change in it, and our report flags that as well. But here's the best part. You don't just get the daily report. You don't just get the signals it recommends. I go through every trade and give you my opinion on which ones you should do and which ones you should avoid. I give you stop loss levels. We track the trades in return, and every week we go through the trade book, update our stop loss levels, and include a 30-day free trial. Here's the best part. You don't even have to sit in front of your computer all day. You put your trades in the morning, update your stop losses, and go out with what you need to do. And the best part, again, 30-day free trial, because look what's coming to McDonald's. Here we look from the CEO. He says, as I reflect on the first quarter of the year, it's clear that broad-based consumer pressures persist around the world. And this is surprising because we're supposed to be in the second half of the year now, which was going to mark a rebound in the economy. Remember, that was the claim. We're going to see a soft landing, and in order to experience that, we need to see consumer rebound here. McDonald's is not seeing signs of that. The CEO goes on to say consumers continue to be even more discriminating with every dollar they spend as they face elevated prices in their day-to-day spending, which is putting pressure on the QSR industry, suggesting that what's coming from McDonald's is going to get worse. And look at the reaction the executives have here. This is shocking. Insiders at McDonald's now have sold 7.6 million in stock, alluding to potential weakness. And you know, of course, when insiders are selling is not a good sign of what's to come. In the last 12 months, the biggest single sale by an insider was when chairman and CEO sold 1.6 million worth of shares at a price of $280 per share. And that means, of course, when they sell at current prices, it makes you a little cautious of what is coming. And how about this? Not one insider bought one share share last year, as you can see in this chart below, suggesting that the insiders know that things aren't getting better, because if they were, they would likely be looking to buy any pullback. But here's the deal. It's not just McDonald's that's facing problems. We have new data now from Domino's that says the consumer is all but tapped out, as their shares crashed the most since late 2008 after temporarily suspending store growth guidance metric. And you would only suspend guidance growth if it was far worse than the market wants to know. And that explains everything what's going on with the U.S. consumer. We're not seeing a soft landing. We're not seeing what's called a no landing. We're seeing something far worse. And wait till I show you what's going on with the labor market. I've got one slide that's going to completely blow you away. Shares of Domino's Pizza and pre-market trading in New York crashed the most since late 2008 following a surprise announcement and earnings report this morning about the company cutting its 2024 international store growth target due to challenges faced by franchisee Domino's Pizza Enterprises. The company temporarily suspended its long-term guidance metric of 100 or 1,000 global net stores annually. Their same-store sales did increase 4.8% in the second quarter, and while that missed expectations, what we see is there's obviously a shift going on here, because if Domino's thought the coming quarter was going to be good, they would have told us. But no, instead what they're seeing is a huge drop in demand, and it's also being experienced not just at restaurants but in the travel industry. As United sees profit below estimates as deep discount sting, and we were told that consumers were eager to travel this summer and were looking to spend big amounts. And what did we just see on the Department of Energy data yesterday is large builds in gasoline and distillates, suggesting that something is wrong, that perhaps consumers aren't out traveling and instead staying at home because they just don't have the money. United echoed rival Delta Airlines in a warning that price cuts by low-cost carriers struggling to fill an excess of seats this summer are weighing on the entire industry. And that's a surprise, because everyone's been saying the airports are packed, but what we now find out is there's excess seats. Domestic-focused discount carriers added too many seats earlier this year that they're now trying to fill by dropping fares, pushing bigger rivals to follow suit to remain competitive. But it makes sense, because we were told by the political elites, by the Federal Reserve, that there was going to be a soft landing and there was going to be this huge boom in consumer spending. And so the airlines ramped up, only to find out that demand is actually far worse than they actually want to admit. Southwest Airlines sounded an earlier alarm, reducing its estimate for second quarter unit revenue last month, citing problems adapting to current booking patterns, suggesting that bookings are likely down. And American slashes profit and sales expectations in late May after it misjudged domestic demand. Again, everybody thought it would be strong, and discounter Spirit Airlines said that second quarter revenue would fall short of its earlier projections, indicating that U.S. consumers are not out traveling because they just don't have the money. It's also perhaps because they're concerned about their job. And this isn't just impacting, of course, the travel industry and the restaurant industry. It's now starting to impact the housing market in a major way. We just found today that D.R. Horton missed orders estimates in quarter with the highest interest rates out there, as lower income buyers are more likely to face problems qualifying for mortgages at a time when borrowing costs are high and delinquencies, and here's the key part, for other types of consumer credit such as auto loans are rising. And it starts to make sense, because if we were indeed experiencing a soft landing and the economy was rebounding, those delinquency rates should be coming down. We should be hearing that consumers' balance sheets are improving. Instead, what do we hear? Domino suspending S projections. We hear McDonald's saying, look, our promotions aren't working. People can't even afford a $5 meal deal. This is a big issue, as the quarter was challenging, one for mortgage rates, with 30-year loan topping 7% for much of April and May, and look for that to come down in a big way. Builders of single-family houses in the U.S. have slowed construction starts in June as inventory of unsold new properties grew, and single-family permits, a proxy for future construction, decreased to the slowest annual pace in more than a year. And here's the big bottom line. Inventory at builders is going up, so the more unsold properties they have. And you think about the time of the year, people should be out buying homes and moving and spending money because they need to move before, of course, the school year starts. If inventory inventory is building at, of course, new construction sites. What that means is demand for labor is going to go down. On top of that, the builders are going to aggressively cut prices at some point. And think about this, the resale market can't compete. But all these signs, what's going on with McDonald's, Domino's, D.R. Horton, and the airlines all point to one major problem. And that is with the U.S. consumer. And here we can see initial jobless claims in the U.S. increased by the most since early May. And we've been told by the Fed that, of course, the unemployment rate was going to peak out here. And we've been warning that, no, that's not likely to happen. It's going to accelerate higher. And we just talked about in the show the other day how key it is to watch the initial and continued unemployment claims every week. This is perhaps the most important data series out right now. Initial claims increased by 20,000 to 243,000 this week, ending July 13th, matching the highest level since August of 2023. And of course, the forecast was much lower, but look at this. They've already pawned this off as the increase reflected the impact of Hurricane Beryl, as claims in Texas jumped by more than 11,500 a week, the largest advance in March since March of 2021. The question is it all hurricane related, or perhaps is it really due to the underlying economy? I've got a slide that will change your perspective on this. Let's take a look at what they go on to say. Because continuing claims, a proxy for the number of people receiving unemployment benefits, rose by 20,000 to 1.87 million in the week ending July 6th. Now, this is the big number, but this is not the surprising number. Wait till you see what I've got for you, because the risk here is, even though there is a hurricane shock and that puts people on the unemployment line, the issue is what happens when people go on unemployment and stay on unemployment. That is a sign of the U.S. economy weakening, and it starts to make sense of why we're seeing consumer demand down, and why people can't afford something like a $5 fast food meal. It seems ridiculous, but it's exactly what we're seeing in the economy. Because one thing we note is where continued claims go, which is shown in red, initial claims in blue follow each and every time. And that's the risk here, as more people get on unemployment and stay on unemployment because there isn't demand for the labor market. Well, it means demand is going to fall, and initial claims are going to start accelerating to the upside. And of course, that means at some point central bankers will step in, and initial claims before adjustments for seasonals climbed by 36,824 to 279,000, the highest since January. So we see the seasonal adjustment brought the number down, but unadjusted, you're starting to see the U.S. labor market unwind. Makes perfect sense why McDonald's is saying what they're saying, why Domino's doesn't want to report what their projections are, because they know it's going to get ugly and fast. And we can turn to the United Kingdom, where we see what's coming for the U.S. labor market as wage growth slows in a sign of weakening jobs market. And you want to wonder why consumers don't have money. It's not just because people are hitting the unemployment line, albeit in small numbers. It's because for those who are working, that wage growth is slowing and continuing to slow, and hours of work continue to decline. Average hourly earnings, excluding bonuses, rose 5.7% in the 3 months through May from a year earlier, down from 6% in that period. Private sector wage growth, which is being watched most closely by the Bank of England for signs of a tight labor market, slowed from 5.6 to 5.9%. Both were the weakest readings, and this is key, since 2022. Unemployment held at 4.4%, the highest rate since 2021, but look for that to go higher, because when we look here at the U.S. data, and why I want to point out what's going on in the U.K. is because what's happening there is soon to happen here. And if we look at total compensation, this is shown in blue as average hourly earnings multiplied by average weekly hours of production and non-supervisory employees, and we put that on a year-over-year rate of change, so we can see the times when it's decelerating, and that matches perfectly with periods where continued unemployment claims are rising. So think of this from an employer's perspective. You see people, of course, demand going down in your business, so you start laying people off. Your existing employees still demand, of course, increase in wages, but you don't have to give them that many, because the risk is if they ask for too much, maybe they're the next one you let go. And you can see this evidence in this chart repeatedly, that anytime you see a rise in continued unemployment claims, it's matched by a deceleration in total compensation growth. So we look to where we are right now, and we're on a steady path path of deceleration in total compensation, meaning consumers have less money to spend, which is exactly what Domino's and McDonald's and the airlines are all saying. Consumers don't have the money, and because they're not spending, what's happening is we're seeing a rise in continued unemployment claims, which means initial claims are soon to follow. And we continue to see overall some signs of cooling in the labor market. This from, of course, out of the UK. And yes, you're seeing some signs, and that is until it accelerates, because it's slow at first and then it hits all at once. Of course, you would think, of course, the central bank in England would respond, but no. Lagarde says the ECB September rate cut meeting will be wide open, and that means they did not cut rates in the European Union, but likely you're going to see central banks cutting in September and accelerating from there, because if you look at what's going on here in the U.S., the federal funds rate shown in blue, which we're expecting at the end of month meeting, the Fed to do nothing. What you're notably seeing here is as continued claims rise, what happens eventually, the Fed reacts, although with a lag, as they try to slow down any acceleration in the labor market falling apart. The problem is we've already seen an increase here, and it's looking to break out. Maybe it's because Barrel sends people home and they stay on unemployment and demand in Texas goes down, but it could be because broadly we're seeing demand in the U.S. economy goes down because workers have less money, they're spending less, their debt service costs are too high, their insurance rates went up. But there's one slide I told you that would be absolutely shocking and perhaps change your perspective about everything. Let's take a look at this, because the non-seasonally adjusted continued unemployment claims jumped a whopping 157,900 last week. This is far more than the seasonally adjusted 20,000, now staying at 1.953 million, just under 2 million, and this number looking to break out to the upside. And if it does, watch out, because it means the U.S. economy is indeed headed into recession. And with the small and mid-sized regional banks already largely insolvent, well, it means we're headed to an all-out financial crisis, one with the Fed likely to drop rates to zero. And even with that, I wonder, will people still be able to afford a $5 meal deal? We'll find out. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.